Welcome back to the channel. My name is Joseph Gutierrez, and this is Covering Compounding. Today, we're going to be tackling retirement planning and how we can guarantee stable income in retirement. Key word here is guarantee. Not only that, we can also grow our income safely as we get older. Now, in previous videos, we've talked about high cash value life insurance, where life insurance policy protects us and our loved ones, as well as giving us a substantial amount of funds in our cash value that we can access in a tax free manner via policy loans. It's a unique asset that benefits us during our working years and gives us the option of supplemental income in later years. That said, for many, the time of getting ready for retirement is now. They don't necessarily have 20 plus years or so of cash value accumulation before they need to start thinking about positioning themselves for retirement. For many, retirement is 5 to 10 years away, and they have some very real concerns about the safety of their IRA or 401k type qualified funds, or even the worst case scenario, running out of money in retirement. This is where our product of choice, the annuity, fits into the picture. An annuity, in particular income based annuities, give our clients something that all other investment based products can only dream of: a guaranteed future stable income. Best way to think about it is where life insurance answers what happens if I die, especially too early, annuity answers what happens if I live too long. Or better yet, how can I guarantee a check every year no matter what happens in the economy? Today, we're going to be looking at one of my favorite and arguably one of the most popular income based annuities in the industry, the Allianz Benefit Control Plus fixed indexed annuity, or sometimes just referred to as Allianz's ABC annuity. We'll go into some detail on pros and cons of different types of annuities, and then we're going to hone in and discover how this particular product can give us way more future returns than most other financial instruments. So let's get at it. So, what is the main draw of annuities that is unique to all other financial products? Well, for one, the annuity protects our principal. And when I talk about annuities, I'm usually talking about fixed interest or fixed indexed annuities. There are variable annuities out there that I'm not much of a fan of because they violate this protection principle. So, whether we're getting, say, a guaranteed roll up of 7% a year, or we're tied to a market index fund, we're always protecting our principal from market volatility or downturns, especially during the deferral or accumulation period. So, say we move over $300,000 into annuity and we're deferring income for a couple of years, we want it to grow without downside risk. The market could crash like 40% like 2008, but if we're in an annuity, we don't suffer any market losses to our account value. That's the primary benefit of an annuity. It protects our principal. Very important. The second benefit is that we hinted on during our intro is the ability to receive guaranteed income for life, lifetime income. This means that our original account value could deplete to zero, but yet the annuity carrier is still guaranteeing that income check for us as long as we, or if it's a joint payout, as long as we and our spouse are alive. This is huge. No other financial product can give us this guarantee. Now, traditionally, financial advisors try to get around this by telling their clients about the 3 to 4% withdrawal rate rule, meaning when we have an investment account with them, usually a mixture of stocks and bonds, we can only touch up to 3, maybe 4% of our account value year after year to hopefully, fingers crossed, not run out of money in retirement. In practice, this leads to anxiety for the retiree and usually not enough money to maintain anything close to their custom lifestyle in retirement. Now, all this can be avoided with the right annuity. Because insurance carriers can give us these guarantees, the annuity is uniquely positioned as a solution to this problem. So, now that we understand the basic benefits of annuities, let's dive into the concept behind annuity construction and then to our featured product, the Allianz Benefit Control Plus annuity. Now, when we talk about annuities, generally we can lump them into two separate categories: accumulation focused annuities or income focused annuities. What's cool, and what we'll see later in the video, is that the Allianz Benefit Control Annuity borrows concepts from both to make what I consider a super annuity. So let's start with an accumulation focused annuity. When we fund our accumulation annuity, We fund, let's say, $100,000 rollover from our old 401k or IRA account. The funds go into the annuities accumulation account, but more specifically, the insurance carrier allocates those funds to what's called the general account. Now, the general account is inside the annuity and it's made up of fixed income instruments. Sometimes they'll include investment grade corporate credit, maybe muni bonds, or dividend aristocratic stocks, but mostly it's tied to the king of fixed income, the treasury bond. The insurance carrier does this because they need safe, reliable income to back their products and their guarantees. The general account is pretty much the heart of the annuity and also life insurance in general. So, at the beginning of every anniversary period, the yield from the general account is peeled off and used in the annuity. Let's say, for the argument's sake, that's 5%. In reality, it's a bit more than that, but let's say it's 5%. Of that 5% that gets peeled off, maybe 1% goes to the insurance carrier that pays the company's employees the overhead and keeps the business profitable so they can make those kind of guarantees that annuities have. The remaining 4% will be used for crediting. Now, assuming we have a fixed index annuity, this will be used for what we call our option budget. Of course, we could just take that amount as fixed interest. But if we want to grow at our highest potential, we should be incorporating the index strategies. So, this 4% will be used for our option budget tied to our index funds. Now, every insurance carrier has plenty of indices to choose from. Some indexes or indices are benchmark type indexes like the S&P 500 and their variations. Some are compositions of different individual basket of stocks, bonds, and cash offered by different investment banks like JP Morgan, Morgan Stanley, Bloomberg. Just about all these index funds options have volatility controls in place. We may see notations like ER at the end, also known as excess return versions of a particular index. Without getting too into the weeds about this, these excess return index variations smooth out some of the index price volatility against a benchmark return, like the SOFR rate or Fed funds. The point is that in doing so, we get an added bonus in terms of a heightened participation rate. In layman's terms, a participation rate is essentially a multiplier. So if you see in our video on Index Universal Life and how it works, you'll see some similarities here. So the way it works is let's say we have an index option of a 1 year index strategy with say 150% participation rate. Now the carrier will use that option budget to buy call options against the performance of that index fund. Let's say the index goes up 10% in that year period. Well, our crediting formula will be 10% times the 150% participation rate, or in this case, 15% crediting. Applying that to our original $100,000 annuity, we will see our accumulation value step up to $115,000 on our anniversary date. Year after year that goes by, we'll see the step ups in our accumulation value depending on how our index strategy performs. Conversely, if the index goes down during that 1 year period, say minus 20%, because we're using call options, which is a part of the derivatives market, we don't lose money on a market downturn. The call option just expires worthless, and we're left with our original $100,000 in our accumulation account. Remember, with fixed index annuities, we only follow or mirror the index, we're not directly investing in it. This allows us to profit on the uptrend and skip over any losses in a downtrend of that particular index. Very powerful, and one of the reasons I'm a fan of annuities and why I'm not a big fan of the 401k. There's too much downside risk. It's also worth noting that many insurance carriers will offer a premium bonus on the rollover, which means we get an immediate injection of additional cash into our accumulation account. Now, if our bonus is 20%, in using our example on the rollover of the initial 100,000, we would show 120,000 in our accumulation account day one. If we apply that same crediting in our example of that 10% times 150% participation rate, then our end year result would be $138,000 at that hypothetical 1 year anniversary. It's not bad. Now, accumulation annuities work great for individuals trying to grow their retirement money in a tax deferred efficient manner with having that downside protection in the market. Those are some of the plus sides of the accumulation annuity. But what are the negatives? Well, for some, there may be an internal account management fee. Also, sometimes insurance carriers will offer bigger participation rates for an additional fee. So it pushes up our potential returns and it gets subtracted. That fee gets subtracted at the end of the crediting period. Not every annuity has fees though, so it's important to inquire that with your agent. Another potential negative is the surrender period. Now, there's some naysayers of annuities that exaggerate this aspect of the annuity to say that the annuity is not liquid, and that once we put our money into an annuity, we can't get it back out for a while. And this is a fallacy and not terribly accurate. The surrender period is merely a vesting schedule applied to the withdrawal amount, usually after a 10% free withdrawal. So, just like your 401k program at your job may have a vesting schedule to say the employer's contributions isn't 100% vested until, say, 5 years of service, in the same way, annuities will have different surrender charges during that deferral period, whether it's a 7, 10, or 15-year deferral annuity. The surrender schedule drops from, say, 12 to 10% all the way down to 0%. Once the deferral period is over, the surrender charge is zero and stays there. So let's do a quick example. Let's say we have $100,000, want to withdraw 20% or $20,000 from our annuity, and our surrender amount for that year, their surrender charge is 7%. Now remember, we get that first 10%, or in this case, $10,000, no charge, and the next $10,000 will have that 7% surrender attached to it. So our net withdrawal would be 19,400. As you can see, it's hardly illiquid. Remember, the insurance carrier is putting its resources to work to grow our accumulation value. We want to let them do their job for us. But even still, our funds are still accessible with little penalty. And what's the last real negative here? Well, we don't have that guaranteed income rider attached, that lifetime income rider. Generally speaking, the annuity carrier is expecting the owner to eventually remove all the funds from the accumulation account. It makes it difficult for them to guarantee income for life on this type of annuity. For that feature, we look at what comes next as the income based annuity. Now, with an income annuity, we have the same accumulation account and death benefit, but we also have the addition of another account, sometimes called the benefit base or the protected income value, or oftenly just referred to as the income account. It's an account value that our guaranteed income is derived from. Now, it's important to remember that although this account runs parallel to our accumulation account, we can't surrender or withdraw directly from it. It is merely the account the insurance carrier uses to generate our income check. So, in our hypothetical example, we'll use the classic income annuity with what's called a guaranteed roll up rate. This is great for those that are tired or suspicious of the stock market. So, in this example, the annuity carrier will guarantee an automatic percentage irrespective of what's going on in the market. So, let's say it's about 7% a year. Each year that goes by, the income account will go up by 7%, compounding until we are ready to turn on our lifetime income. Once we flip the switch and turn on our lifetime income, the insurance carrier will apply a payout percentage based on our age, whether we want increasing or level payout, and if it's single or joint recipient. So let's use our quick example here. Let's say we're 60 years young and we move over $100,000 into our income focused annuity with a guaranteed roll up rate of 7%. Let's also say that we defer until age 71 to turn on that income. So after about 10 years of roll ups, our income account now says roughly $200,000. We then elect to turn on our income in our 71st year. Applying it to our payout percentage, let's also say it's about 7% as well. We'll receive an income check of about $14,000 per year, or that amount broken up into monthly checks for us. As the years go by and we continue to take income, our accumulation account and our income account will reduce accordingly. What's important about this guaranteed income annuity is that it could drop all the way to $0 in both accounts, but we are still getting that, in this example, $14,000 check per year. We could be 94 years old and our Accumulation and income accounts have been zero for 10 years plus, yet we're still getting paid the guaranteed payout. It's pretty powerful stuff. Try that with any other financial product and you'll have a hard time getting a guaranteed payout. So, what are the negatives about this particular product? Well, because we're putting all of the insurance carrier's efforts into the income account to grow it in a guaranteed manner, our accumulation account will be neglected to a certain extent. The growth in the accumulation account will be minimal, so if we want to turn around and surrender the policy and basically take the money out and walk away, we won't have too much to show for it, too much gain at least. That, and an additional possible negative, is that we kind of need a decently large account to roll over into annuity from the start. Now, $14,000 a year is nice, but it's not going to impact most people's lifestyle that much. So, in order to make the income annuity work, we need a larger income account to work with by the time we flip the switch for the lifetime income. Now, I know what you're thinking. What if we could get the account growth and the step up effect of the accumulation annuity and pair that with the guaranteed payout of the income annuity? Wouldn't that be something? Well, we're in luck because that's what the Allianz Benefit Control Plus annuity provides us with. It's a hybrid approach that allows us to have the major step ups in our income year after year so that the income has the potential to grow every anniversary period, allowing for increased income and wealth in retirement. So let's go ahead and take a look at some numbers. Okay, so now that we have a pretty good understanding of the different types of annuities, whether it's an accumulation focused annuity or an income focused annuity, let's go ahead and take a look at our featured carrier Allianz Life and their Allianz Benefit Control Plus annuity and see how it incorporates aspects from both different types of annuities to kind of supercharge our lifetime income, our guaranteed income from this annuity. So let's go ahead and take a look at our illustration. So right off the bat, the first thing we notice is that this is a annuity hypothetical illustration for the Allianz Benefit Control Plus. So, like all fixed index annuities, generally speaking, we look at previous performance and apply to today's circumstances, today's participation rates. Okay. So, we may look at the last 10 years, 15 or so years, and then apply it to the next 10 or 15 or so years to kind of get a roadmap as to the possible gains that we could have for this particular annuity product. Now, remember, they're hypotheticals. The reality is going to be based on market performance. For individuals that are not as comfortable with the market and the future performance of the market, maybe a guaranteed roll up type product would be a better fit for them. But for those individuals that want to kind of maximize their possible and potential gains, a type of annuity like this would be one to consider. Okay, so let's go ahead and roll into this illustration. Okay, so there's a lot of information in the illustration. Obviously, we're not going to be spending as much time on all these different sections, but we'll touch in on the notables. Okay, so first things first, in this particular illustration, we're looking at a 60-year-old male. He's moving in $300,000 into his annuity. Okay, and we can see here on the next page, we can see that Allianz Life Insurance Company of North America, or Allianz for short, is one of the top rated insurance carriers for index universal life as well as annuities. They are they have very high financial strength and rated A plus with AM Best and some of the other organizations here. They're basically our top carrier we like to work with, especially for index universal life and annuities. Okay, and it's arguable that this is their top annuity product as well. All right, moving on down. Okay, the name of the game when it comes to this particular annuity is increased income potential. Okay, we can kind of see this in the first paragraph here on this page here. We see that inflation, taxes, healthcare rates are rising. Okay, so Americans that are approaching retirement in the last 5 years, we've all seen it. The price of groceries, the price of everything, inflation, interest rates have all gone up. So our annuity needs to kind of keep up with that kind of standard level payout of some of the traditional income annuities although those are fine, they're not growing with us. We want an annuity product that can grow with us in the same way that we have the accumulation focus annuities. So, one of the reasons that I like this particular annuity is that our guaranteed income steps up year after year, depending on how the market does. If we have a positive year in the market, we can have increased payouts as the years go on. Okay, all right. So, moving on to the next page here. Okay, we can kind of see this funny looking chart here, this funny looking graph. On the leftmost side, we see our accumulation value, and the rightmost side, we see our annual income withdrawal. Okay, to say that it's kind of showing both and how they interact. So, our accumulation value, remember, this particular annuity, we are sacrificing some growth with the accumulation value to kind of boost up and pump up our what they call the PIV or the protected income value. That's basically the income account. Okay, so we see that even though our accumulation value does decrease pretty quickly by the time we start taking income, in this case, it's going to be the 11th year, we can see that our income is increasing quite well. Okay, so in the hypothetical range here, if we put in $300,000, 30 years later, we may begin on the order of $600,000 plus as income in retirement. And you can see each of these step ups depending on how the market is doing. Okay, let's go ahead and move on down. And remember, we can even see this here on this line, D here. Note, even if your accumulation value depletes, your income payments will continue for the rest of your life. Okay, that's nice. That's what we're looking for with a income annuity, that guaranteed lifetime income. All right, some of the key terms. We're not gonna spend too much time on this. We'll just talk about some of the notables. Okay, right off the bat, we've seen some of these terms already. The accumulation value. Okay, cash value. This is sometimes called the surrender value. This is what we can draw from if we were to surrender or withdraw during that deferred period. Market value adjustments, that has an interaction with the cash value. We're not going to spend a whole lot of time on that. During a consultation, we'll spend a little bit more time on some of these other notables here, but we'll kind of jump to the important pieces here for this annuity in particular. So for this annuity in particular, we have this bonus control benefit options. We have two different options. We have the balanced PIV and the accelerated PIV. Remember, the PIV is protected income value, or that's the income, and that's the income bucket. All right, so we see that we have some different bonuses. So it's kind of like an extra participation rate if you want to kind of categorize it that way. Now, during our deferral period, we can choose one or the other. So we're deferring for about 10 years in this example. Okay, so we have a balanced PIV interest bonus option and an accelerated PIV bonus option. Okay, so for the balanced one, we have 150% times whatever we're getting from our index. So remember our example earlier, say we had 10% times the 150% participation rate, or 1.5. That'd be 15% crediting for that year in that example we used earlier. We would then apply these bonus numbers to that return. Okay, so our accumulation count, if we're looking at the balance, our accumulation count would just be the 15% because it's times 100%, 1.0. Okay, so our accumulation 1 1.0, and then our PIV, or our income bucket, if you will, be 15% times 1.5. Okay, so do the quick math in your head there. 22.5% would go towards our PIV. Okay. Now, when we're looking at this kind of annuity, we would probably best be served for most of my clients to be using the accelerated PIV. Why? Because even though we're sacrificing some of the gain on the accumulation value, we're getting, we're getting an increased PIV interest bonus of 250%. Okay, so if we get, let's just do real quick, we got 10% crediting for that particular year, and we multiply it by 2.5. Well, we got 25% jump or step up in our PIV, our income account there. Huge percent increase. Okay. So if we want to really grow our PIV or really grow our income potential, we want to focus in here on the accelerated PIV interest bonus. Okay, so also remember that once we do turn on income, in this case, the 11th year, once we do turn on that income, it's going to switch over to the balanced version. But nonetheless, uh, our goal here is to accumulate as fast as we can or as well as we can during that deferral period, if we can. Okay. All right. Moving on, we'll touch in a couple more sections here. Protected income, the protected income value premium bonus. So we got 25% on the initial deposit into the annuity, and we have eight in our first 18 months. We can get that extra 25% premium. Okay. Moving on down. Okay, we have this lifetime withdrawal section. Okay, so this is when we turn on income. It depends on a number of factors. Remember, for our traditional income-based annuity, we had whether it was level or increasing, or whether it's single or joint, or and then also the age. Okay, so for this particular type of annuity, we're only interested in the age, or whether it's a joint payout, like a kind of a husband-wife scenario, or just a single uh, receiver of that income. That this product is obviously the payout percentages are slightly lower, but the potentials are much higher. Okay, so next we'll touch on a few other items here. Uh, so for one, there's this income flex benefit. We're not going to spend a whole lot of time on this. This is instead of taking a step up in your income, instead you can take that percentage gain and apply and basically have a larger lump sum taken from the accumulation value. This is maybe not as important as the step up, in my opinion, but for some retirees, they need kind of a larger amount of a lump sum instead of just that general income that's coming off of the lifetime income stream. They can choose to use this. Obviously, it's going to accelerate drawing down the accumulation value, but it is there if they want it. Next is the death benefit. Again, death benefit, it's not a big item with this particular annuity because the accumulation, the PIV values do decline pretty precipitously. But if you were to say the insured or the annuitant were to pass away before they start taking income, they've built up all this accumulation and PIV value. They have two general options with this annuity. So generally speaking, the accumulation value usually equals the death benefit. So we can have that large that large lump sum in that 1 year and to our beneficiaries here, to our beneficiaries if a death were to occur, especially before income was taken. We can also do is we take our PIV value, which is tends to be higher than our accumulation value, and we can disperse over a 5-year period so long as the PIV is not greater or the maximum that it could be dispersed over a 5-year period would be 2.5x or 2.5 times the accumulation value. So if our accumulation value is $100,000 and our PIV is 250,000, well, we could either have one or two different options for our beneficiaries. We could have our 100,000 dispersed in one lump sum, or we could have 250 dispersed over a 5-year period. Okay, assuming that we still have values for that. Generally speaking, with this type of annuity, the accumulation, the PIV value or the income account there do decrease pretty rapidly because we are putting all of our emphasis on that lifetime income. Let's see here. A few other notables. I won't spend too much time on this, but We do have an enhanced penalty free withdrawal. So remember that surrender period and being able to withdraw funds during our deferral period. We had a free 10%. Well, if the annuitant here were to not take out any withdrawals the previous year, the maximum is actually 20%. So maximum of 20% free withdrawal without any kind of surrender charge. Okay, assuming the previous year did not have any withdrawals. Okay, so that's kind of a nice little thing where even though we're deferring and accumulating, we still have access to our funds. We could get up to 20%. So it's a nice liquidity rider, if you will. All right, so this is talking about different index options, the crediting. Okay, we're not going to spend too much time on that. We're going to skip over that for now. Obviously, during a consultation, we'll be going into more in depth about these different topics, but for today, we're kind of doing an overview on this annuity. Okay, so in this illustration, we have some assumptions. We're using different index allocation or different index strategies. We're using the Bloomberg, US Dynamic, number 3 ER. Remember the ER, the excess return. And we're using a 2 year. So it's going to be utilizing a 2-year call option kind of in the background of the annuity. So basically, if we were looking at it, say if it's July 2025, we would look all the way to July 2027. So we look at the price action. So a starting price and then the final price. What percentage gain between these two numbers? Okay, so once that 2 years completes, then we look at what kind of gain that is, and that is the basis for our crediting. So we have two different indexes. We're looking at the Bloomberg and the Morgan Stanley Strategic Trends. Both have different participation rates. Both do quite well over time. All right, so let's go ahead and move down. So kind of the meat and potatoes here. You can see some of the numbers. Okay, so we're going to look at the hypothetical, the last 10 years. Okay, so as far as crediting goes, we're going to take data from the last 10 years and then superimpose it as if for the next 10 years to kind of get an idea, kind of a roadmap on how this annuity could possibly do. All right, so we see our immediate premium at age 60 of $300,000. And right here on the PIV in the first year, we see that we had that 25% jump in our PIV value. That's that bonus, the PIV value. We're kind of borrowing that concept from the accumulation-based annuities. Okay, remember this is a 2-year strategy. Okay, so every 2 years we take the crediting. So at the end of this 2-year mark between the two different index choices, because we have 50% weighted on each side here, we're seeing that we're getting 6.36%. That's just the base crediting after our participation rates are factored in. Okay, so because we are using, if we scroll back up and don't forget, we are using this accelerated PIV, we're getting 250% on our protected income value and 50% on our accumulation. So if we go ahead and scroll back down, we can see that quite plainly here that our protected income value is 2.5 times this 6.36. So it's coming in at 15.9. We see how we get this large jump in our PIV. Okay, so that's what we want to see. We want to see our PIV grow as efficiently and accented as much as possible. So that's why we like to use that particular bonus strategy. Okay, we also see that we do sacrifice somewhat for the accumulation value so that our accumulation value crediting is about half what we receive. So it's going to be 3.18. Okay. All right. So, but that doesn't really bother us too much because we are interested in income after all. So every year that goes by, we can see the crediting and we see these rather interesting numbers. You can see year 4 here, we got 19.6% on that 2-year call option against those two different strategies, which translates into 49% on our PIV. So we see these large jumps, right? Every 2 years, depending on how the index is doing, right here, even more, 32.4% translated into 81% on our PIV. Okay. All the way until we get to our 11th year when we turn on income. And remember, we take 5%, that's our payout percentage, 5% on our total PIV. So our total PIV is 1.9 million times the 5%. That brings us to roughly, it looks like $95,000 of income that year. And then we can see how, as the years goes by, we see that our protected income value kind of falls off here until it gets to zero. So does our accumulation value, drops down to zero pretty quickly. But yet, we are still getting this large lifetime withdrawal here. 95,000, 95,000, 104, 104, 135, 135, depending on how this index is doing, okay? And we can see that after 30 years, let's say we get all the way up to 30 years for this hypothetical example, we're pushing 90 years old and we're getting $614,000 a year as income off of this annuity from that initial deposit, only that initial deposit of $300,000 about 30 years prior. And we pulled out a total amount of income in this example, almost $6 million. So you can see how um, by putting all of our weight into this protected income value accumulation and utilizing this particular annuity, we're seeing fantastic numbers over time. Okay. On one more page here, we'll take a quick look. This is a hypothetical example of the last 14 years, and we can see kind of some slightly different numbers. We can also see that we actually get a bit more in our first year. Instead of the 95, it came at 145,000 dollars and then increasing thereafter. Okay, so this is the benefit of this particular annuity. We're growing our income bucket, our income account as much as possible, our protected income value during our deferral period, and see how this particular annuity has generated significant payouts in the form of this lifetime withdrawal income, and how basically we put all of our focus into the protected income value and how we're able to pull out considerably more income than we started with, on the order of 20 times over the course of a 30-year period in this example. Okay, thank you for watching our video. In today's video, we took a look at the Allianz Benefit Control Plus annuity, and we looked at how it can accentuate our lifetime income, how it borrowed from the different aspects of accumulation-based annuities and income-based annuities to basically build one of the better annuities out there for guaranteed lifetime income, and how we can basically accentuate our future payouts depending on our market, our index strategies. Okay. If you are looking at possibly putting together your own annuity, or if you're looking at a life insurance policy, feel free to click the link in our description. Okay. It'll take you to our website where you can see much of our information. You can also see that we have a book now button where you can schedule a free online consultation. And during that consultation, we'll take a look at kind of your financial situation, what are your goals, and seeing how possibly one of these products can further help you accomplish those. Okay. As we do with all of our consultations, we do offer free policy reviews. So if you do have an annuity, if you do have a policy with another agent, we'll give you our opinion if we could possibly do something better or how we can accentuate what you already have. Okay, thank you for watching. Click like and subscribe, ring the bell, leave a comment, and I look forward to seeing you on our journey towards financial independence using the foundational asset. Until next time.